Hey everyone! Welcome back to the channel. Today, we're going on a fascinating journey to explore which investments have been the most profitable over the past 15 years. We'll compare some of the heavy hitters like stocks, real estate, gold, and cryptocurrencies. And don't worry if you're new to investing, I'll break it down so it's super easy to understand. We're going to look at the average annual returns of each asset class over this period, and I'll share some insights into why they performed the way they did. Remember, past performance isn't necessarily indicative of future results, but it can give us valuable clues. By the end of this video, you'll have a much better understanding of how these popular investments have performed historically, and you'll be equipped to make more informed decisions about your own investment journey. So, let's dive right in. First up, let's talk about. When you buy a stock, you're purchasing a small ownership in a company. Over the last 15 years, the stock market, particularly the S&P 500 in the US, has averaged about an 8 to 10% annual return. Even when you factor in big dips like the 2008 financial crisis and the 2020 pandemic crash. Now, 8 to 10% might not sound like a lot, but remember the power of compound growth. Imagine investing $10,000 and earning an average of 8% per year. After just 10 years, your initial investment would have more than doubled to over $21,500. That's the magic of compounding. Of course, past performance is not indicative of future results, and the stock market can be volatile in the short term. But over the long haul, stocks have historically been one of the best ways to grow your wealth. Think of it like this: when you invest in the stock market, you're investing in the growth of the economy as a whole. As companies innovate, expand, and become more profitable, their stock prices tend to rise, and so do the returns for investors. Plus, there are tons of different stocks to choose from, so you can diversify your portfolio and invest in companies that align with your values and risk tolerance. Whether you're interested in tech giants like Apple and Amazon or more stable blue-chip companies like Johnson & Johnson or Coca-Cola, there's a stock out there for everyone. But remember, investing in individual stocks can be risky. That's why it's crucial to do your research, understand the companies you're investing in, and consider diversifying your portfolio with index funds or ETFs that track the broader market. By investing consistently in the stock market over the long term, you're giving your money the opportunity to grow significantly and potentially outpace inflation, which is crucial for building lasting wealth. Next we have, this is a favorite among long-term investors for building wealth. Over the past 15 years, U.S. real estate has seen about 3 to 5% average annual growth in property values, not including rental income. For those who held on to properties through economic ups and downs, real estate has been a stable asset. Even after the 2008 housing crisis, the market eventually recovered and hit new highs. One of the main reasons people love real estate is that it's a tangible asset. You can see it, touch it, and even live in it. This tangibility can provide a sense of security and control that you might not get with other investments like stocks or bonds. Another advantage of real estate is its potential for generating passive income through rentals. By renting out your property, you can create a steady stream of cash flow that can help cover your mortgage payments and other expenses. And as rents tend to rise over time, your passive income can increase as well. Plus, real estate often acts as a hedge against inflation. When the cost of goods and services goes up, so do property values and rental rates. This means your real estate investment can maintain its value and even grow during inflationary periods. Of course, real estate investing isn't without its downsides. It requires a significant upfront investment, and it can be illiquid, meaning it can be difficult to sell quickly if you need to access your money. And let's not forget about the responsibilities that come with being a landlord, like property maintenance, tenant issues, and potential vacancies. But despite these challenges, real estate remains a popular and potentially lucrative investment strategy, especially for those seeking long-term growth, passive income, and a hedge against inflation. Now let's talk about. Gold is known as a safe haven asset, meaning people buy it during economic uncertainty. Over the past 15 years, gold has provided around 5 to 7% annual returns. It tends to hold its value when markets are shaky, making it a reliable store of wealth. But keep in mind, unlike stocks or real estate, gold doesn't generate passive income. For centuries, gold has been seen as a symbol of wealth and stability. It's a physical asset that's scarce, durable, and universally recognized. making it a popular choice for investors seeking to preserve their capital during times of economic turmoil. When traditional markets like stocks and bonds experience downturns, investors often flock to safe haven assets like gold, driving up its price. This inverse correlation to other asset classes can make gold a valuable tool for diversification, potentially mitigating losses in your portfolio during market volatility. However, it's important to note that gold's price can fluctuate significantly in the short term, and its long-term returns haven't always kept pace with investments like stocks. Plus, unlike dividend-paying stocks or rental properties, gold doesn't generate passive income. Its value lies solely in its price appreciation. So, while gold can be a valuable addition to a diversified portfolio, especially for its potential to preserve wealth during economic uncertainty, it's essential to have realistic expectations about its returns and understand its limitations. Don't go all in on gold just because it's shiny and has a long history. Consider it as part of a balanced investment strategy that aligns with your overall financial goals and risk tolerance. Lastly, let's look at in this list. Cryptocurrencies like Bitcoin and Ethereum. Cryptos have only been around for a bit over a decade, but their growth has been incredible. Bitcoin, for example, went from being nearly worthless in 2009 to reaching over $60,000 in recent years. That's massive. Cryptocurrencies have taken the world by storm, offering a decentralized and digital alternative to traditional currencies and financial systems. Their meteoric rise has captured the attention of investors worldwide, enticed by the potential for massive returns. Bitcoin, the first and most well-known cryptocurrency, has become synonymous with this new asset class. Its limited supply, decentralized nature, and growing adoption by institutions have fueled its price surge, turning early investors into millionaires. Ethereum, another major player in the crypto space, has also experienced explosive growth. Its platform allows for the creation of smart contracts and decentralized applications, opening up a world of possibilities beyond just digital currency. However, it's crucial to remember that the cryptocurrency market is still in its infancy and is incredibly volatile. Prices can swing wildly in short periods, making it a high-risk, high-reward investment. Investing in cryptocurrencies is not for the faint of heart. It requires a strong understanding of the technology, the risks involved, and a high tolerance for volatility. Before diving into the crypto craze, it's essential to do your due diligence, invest only what you can afford to lose, and consider it a speculative portion of your overall portfolio. So, what's next for these assets? Predicting the future of any market is inherently uncertain, but we can look at current trends and expert opinions to get an idea of what the future might hold. The stock market, while subject to short-term fluctuations, is expected to continue its upward trajectory over the long term, driven by technological advancements, global growth, and corporate innovation. However, factors like inflation, interest rate hikes, and geopolitical events could impact market performance. Real estate as a tangible asset with intrinsic value is likely to remain a popular investment choice. Population growth, urbanization, and limited land supply in desirable areas could contribute to continued price appreciation. However, rising interest rates and affordability concerns could pose challenges. Gold, as a safe haven asset, may experience increased demand during periods of economic uncertainty or geopolitical turmoil. If inflation persists, gold could potentially act as a hedge against the erosion of purchasing power. However, its long-term returns might not match the growth potential of other asset classes. Cryptocurrencies remain the wild card. Their future is highly dependent on factors like regulation, adoption by institutions, and technological advancements. While the potential for disruption and innovation is vast, so are the risks associated with this nascent asset class. Ultimately, the best investment strategy for you depends on your individual financial goals, risk tolerance, and time horizon. Diversifying your portfolio across different asset classes can help mitigate risk and potentially enhance returns. Remember, investing is a marathon, not a sprint. By staying informed, making calculated decisions, and investing consistently over time, you can increase your chances of achieving your financial aspirations. Thanks for watching. If you found this helpful, don't forget to hit that like button and subscribe for more investing tips. And let me know in the comments, what asset are most interested in. Remember, investing is a journey, and the best way to learn is to start small, diversify your portfolio, and stay informed. There are tons of resources available to help you get started, so don't be afraid to dive in and take control of your financial future. Until next time, happy investing.